Hello, everyone. I hope you had a wonderful 4th of July and are enjoying your summer. We wanted to chat about our mid year outlook today. The first half of 2026 has been anything but uneventful. Investors navigated significant geopolitical developments and major policy changes. During the second quarter, Kevin Warsh began his tenure as the 16th chair of the Federal Reserve, succeeding Jerome Powell. The United States and Iran signed a memorandum of understanding that has eased tension in the Middle East, and SpaceX completed the largest initial public offering, making Elon Musk the world's first trillionaire. While these headlines captured public attention, the underlying economic picture has remained more nuanced. Many of the economy's fundamental pillars remain healthy. Corporate margins are near record highs. Consumer spending remains resilient. U.S. manufacturing has rebounded, and employers continue to add jobs. Yet several long term challenges persist. Unemployment has remained stable at 4.2%, but inflation has moved higher. Federal debt now exceeds annual U.S. economic output for the first time since World War II, and consumer spending has become increasingly concentrated, with the top 10% of income earners accounting for roughly half of all consumer expenditures. We entered 2026 with expectations that the Fed would continue its rate cutting cycle. Today, the futures market is now forecasting the Fed will increase rates before year end. This represents a significant change in Fed strategy. After reaching an 8-month low at the end of the first quarter, U.S. equity markets staged a remarkable recovery. Technology companies once again played a leading role, but strength broadened out beyond the mega cap stocks. Energy and material companies produced robust earnings growth, helping support overall market performance. Although major U.S. indexes reached all-time highs during the quarter, valuations became more reasonable as corporate earnings grew faster than stock market prices. One thing of note that we're watching is earlier this year, the Supreme Court ruled that the broad tariffs implemented in 2025 exceeded the authority granted under the International Emergency Economic Powers Act. Much of the focus has been on the impact of lower tariffs that will have an impact on consumer prices and less on the actual refunds. These refunds effectively represent a fiscal stimulus. Economists estimate the cumulative impact of the refunds could boost economic growth by approximately 0.5 to 1% of GDP over the near term. As headlines swing between optimism and uncertainty, we encourage investors to remain guided by their true north, the personal values, priorities, and goals that define what financial success truly means to them, and a well designed roadmap provides the discipline to navigate changing conditions with confidence and purpose. If you'd like to learn more about the ever changing economy, the accompanying letter provides more insight, or I would be happy to discuss individually. I hope the best for everyone for the second half of 2026, and I look forward to how things progress.